Happy morning, people. So today we'll be taking up the MTP series of advanced accounting. We'll start with MTP 2 relating to January 2025 attempt. Overall pretty straightforward MTP. Majority of the questions are from our ICA material and RTPs itself, but one or two new questions have been framed. We will run through. Okay. Again, in the today's session, we'll be looking at the new questions which has been added in this particular MTP. If it is repetitive or if it is around the same concepts, we are not doing that particular questions. Okay. I'll call out which are new and which are repetitive in nature. Case-based questions we will run through. So let's go through first case. Excellence is a real estate company. Okay. Sir, for a real estate company, land, building and all is not property, plant and equipment. Land, building and all becomes inventory because they buy and sell those goods in normal course of business. Keep that in mind. They are constructing residential and commercial projects. So all that is not PP, but it becomes inventory for real estate company. The company has commenced a new project and the following expense has been incurred. Cost of land is 10 crore and for construction they spent 25 crore. That means what is the total cost of the inventory, sir? 10 crore for land, 25 crores rupees for construction. So looks like the total cost of the inventory is 35 crore. These two ka addition, correct? Alright. Company also incurred 10 lakh rupees for various administrative meetings. Stop there. Can you add administrative expenses to the cost of inventory? No. All administrative overheads, selling and distribution overheads, your abnormal loss, all this as per AS2 should be transferred off to P&L account. So this cannot be capitalized. Okay. The construction of building was completed at the end of year 1. The net realizable value of the building was 40 crore. This is an AS2 wala question. So how should the inventory be valued at? Cost or NRV, whichever is lower. How much is cost? 35 crore. How much is NRV? They only gave in the question 40 crore. So how will you value this inventory? 35 crore or 40 crore, whichever is lower. So you'll value it at 35 crore itself. Yes, people? Alright. So let's look at that first answer. At the end of first year, how should the building be classified? For this real estate company, building, will you show it as property, plant and equipment? No. It will be shown as what? Inventory. Okay. And then they asked at the end of year 1, how much will be the value of inventory? At what value will you recognize the inventory? Just now we figured it out. How much is that? 35 crores. So B for Bengaluru is the right option. So then let's read the case further. At the beginning of next year, that is year 2, company decided to use the building as a corporate office. So first year when they constructed, what was the intention? To use it for their purpose or to sell it? Sell it. That means in the first year, this was an inventory. Yes. In the second year, is it still inventory? Does the company have intention to sell it or use it for their own business purpose? They are using it for their own business purpose as corporate office. That means in the second year, is it inventory? No. You'll have to reclassify from inventory to property, plant and equipment. Yes, sir, people? Same. What is the cost of inventory? 35 crore. That means the cost of PPE also will be 35 crores only unless they give any other extra information. We'll see. The company further incurred 50 lakh rupees for making necessary changes in the structure for using it as a corporate office in accordance with the government norms for commercial spaces. Without these changes, office cannot be set up. That means all this cost, sir, you have made some alteration, all right, because you want to use it for your corporate office purpose now. So as per the government norms, you need to do some alterations. Unless you do those alterations, can you use it for your business purpose? No. That means this 50 lakh rupees is what? This becomes your directly attributable cost. Can you add directly attributable cost as per AS10? Yes, DAC can be capitalized. In fact, as per AS10, we have studied purchase cost, then DAC, DSR, present value of DSR cost, all this can be added to the cost of PP. So can you add this? Yes. That means what will be the value of PP? The value of PP will be, what was the value of what was the cost of inventory, sir? 35 crore plus 50 lakhs or 0.5 crores, can I say? That means the value of PP will be how much, sir? 35.5 crores for year 2. Ignore the effect of depreciation. Fair enough. Now they have asked at the end of year 2, the intention to use the building as corporate office. How will you classify this? Will it still be shown as inventory? No. Now it will become what, sir? Property, plant and equipment. Now they are saying at the end of year 2, how this project will be valued. This project now is a property, plant and equipment. How much it will be valued at? They asked us to ignore depreciation. That means ignoring depreciation, PP ka value will be how much? 35.5 crores. So B for Bengaluru is the right option over here. Pretty straightforward case combining AS2 and AS10. Any doubt? No? So quick review we will do. Will that be okay with you? So can I go for the next question, sir? Okay, great. Question number 2, online also. I hope everything is looking good. Yeah, if there is some issues, let me know in the chat box. If I don't hear anything, that means I'm thinking that you guys are good and I shall move forward. Alright, Super Cool Limited is a manufacturing company engaged in manufacturing eco-friendly equipment. Some equipment manufacturers they are. On 1st April 2023, company received a grant of 20 crore rupees from the government. That means probably this is a question on accounting standard 12 that talks about government grants. Alright, how much grant we received? 20 crore, which is 25% of paid up capital of the company. So that means this grant looks like a revenue grant or a capital grant. Capital grant. 25% of the capital government has contributed. That means this grant looks to be in the nature of what? Promoters contribution, and we have studied as per AS 12 grants which are in the nature of promoters contribution should be shown in a shareholders funds under capital reserve. Looks like that. Let's read the full components and then figure it out. For various purposes, this grant is received not for one purpose but for various purposes which the company deems fit. And no repayment is required to be made to the government. Such Dharala Prabhu our government is. Government gave 20 crores to the company and telling the company, you use it for whatever purpose you deem fit. Is there any specific purpose for which this grant has to be utilized? No, company ka choice. And is there any any restrictions on the repayment part? No. But studying this, we got to know that since this constitutes 25% of paid up capital and since there is no purpose attached to it, this grants looks to be in the nature of what, sir? Promoters contribution. What is the journal entry for grants received in the nature of promoters contribution? Bank account debit to capital reserve. How much grant you received? 20 crores. Okay. The company also borrowed 10 crore rupees from financial institutions and interest on that is 1 lakh. Okay. The company acquired plant and machinery from the funds for 10 crore and 1 crore was spent on installation. Installation charges becomes your DAC. Can you add installation charges to cost of PP? Yes. 10 lakh was spent on professional fees necessary for installation. That means this 10 lakh is also what, sir? DAC. Company also spent 50 lakh rupees on revenue expenditure. Revenue expenditure means a DAC or it goes off to P&L? P&L account. That means can you tell me what is PPE ka value, sir? How much did you buy it for? 10 crore. How much was the installation charges? 1 crore. Then how much was that professional fees? 10 lakh. All these numbers are in crores. So 10 lakh if I have to convert in crore, it will be 0.1 crore. So the cost of PPE will become 11.1 crore so far. Yes. Alright. Plant and machinery was ready for its intended use on 30th September 2023 and we have studied as per AS 10 depreciation start from the day asset is put to use or available for use? Available for use. So from the current year starts on 1st April. From 1st April only is the asset ready? No, it is ready only on 30th September. Maybe it's a complex machinery. It requires a lot of time for installation, which we don't know. But when is it ready from? 30th September. That means that depreciation will start from what day, sir? From 1st October, depreciation starts till 31st March. If you count how many months is that? October, November, December, January, February, March. That means in the current year, you'll charge depreciation only for 6 months. The depreciation on this asset is how much? 10%. So that's what they have given. So let's read the case ka requirement. How should this grant of 20 crore should be presented? Where will you show this grant? As capital reserve. I called out the journal entry also for your reference. Now they are saying what is the value of plant and machinery not on 30th September but on 31st March 2024. That means they are asking the value of plant and machinery at the end of the year. Value of PP on 30th September is how much? That we already got it over here. Value of PP on 30th September is 11.1 crores. Now in the current year you have to depreciate the asset for 6 months. So calculate depreciation on this for 6 months. You will get 55.5 lakhs. Reduce that. After that you will get the value of plant and machinery at the end of the year, which is 10.545. Which option has that? C for Chennai. So that's the value of PP at the end of the year after depreciation. Pretty straightforward. Yes, no? The revenue expenditure of 50 lakh, where will you recognize? Will you capitalize or P&L? P&L. Obviously this one you have to transfer it to P&L account. Which of the following statement is true? The plant and machinery has been acquired out of government grant, so the same should be disclosed at nil value. PP should be shown as 0. Is this grant really related to asset or it was an open grant? The government gave 20 crores and said you use it for whatever purpose you want. Is it grant really related to plant and machinery? No. So we know, we have studied, if there is a grant which is related to a specific depreciable asset, then there are two acceptable methods. One, we can follow asset cost reduction method, another one deferred income method. Is that relevant here or not relevant? No, because the grant was not related to machinery. Grant didn't have any purpose at all. So first option is right? No. Plant and machinery belongs to financial institution. You took a loan? No. So asset belongs to that financial institution? No. Plant and machinery belongs to the company and it should be recognized as PP. Yes, this is the right option. And it should be recognized at what value? 10.545 crores at the end of the year. So C for Chennai is the right option for this particular MCQ question. So far, looks like all the MCQ questions are straightforward. Nothing much there. Yes. Can I move along? Okay. Next question. Super Limited is a manufacturing company. It has summarized balance sheet information they have given. Equity shares of 10 each fully paid up. So this is rupees 70 lakh. So total face value of equity share capital is 17 lakh. Each share ka face value is 10. So how many shares we have? 1,70,000 shares of 10 each. Correct, people? Yes. Okay. Revenue reserve, as in general reserve, is 23.5 lakh. Is revenue reserve a free reserve? Yes. Security premium? No, it's not a free reserve. But is P&L a free reserve? Yes. Infrastructure development reserve, export profit reserve, infrastructure development reserve, CRR, DRR, all these are not free reserves. Okay, sir. Now, as I said, before you blindly read the question, it is always better that first you read off the requirement so that you will get the clarity of the case better. If you just check the buyback, that means this whole question is on buyback. How much you can buy back and how much you can buy back as per you have three tests: share outstanding test, resource test, and debt equity test. Those they are asking as requirement. That's it. We have done 4 or 5 questions in our regular class on this. So there is nothing new. It is straightforward data. But still, nonetheless, as a recap, I'll just quickly run off this question also. Alright. So they have given secured loan. 9% debentures is 38 lakh. Unsecured loan is 8.5. For debt equity ratio, we need debt. No. Adding these two will get total debt to be how much? 46.5 lakhs. PP, all this data I don't need. Fine. The company is planning to buy back 35,000 equity shares of 10 each. That is what company wants to do. Anything they want, they can buy back, or there is a restriction. In fact, 3 conditions you need to test, and you need to take the highest of the 3 conditions or the lowest. Lowest of the 3 conditions is what you can buy back as per Companies Act of 2013. But company ka wish is that they want to buy 35,000. And buyback price is how much? Face value may be 10, but the company wants to buy back at 30 per share. The buyback is authorized by the article since a resolution has been passed. Okay, answer the following question. As per Companies Act 2013, the buyback in any financial year must not exceed what? 25% of paid up capital and free reserve. Free reserve for this purpose also includes what, sir? Securities premium. We have discussed this in class. Though security premium is not a free reserve, for the application of buyback provision, even free security premium is also considered as buyback. Correct? So this is the right option. Correct? B for Bengaluru. That's a theory question. How many shares can the company buy back according to share outstanding test? What does the first test, share outstanding test, say? How many ever shares you have, of that 25% you can buy back in the current year. How many shares does the company have? 1,70,000. 1,70,000 ka 25% if you do, how much you're going to get? 42,500. So that means B for Bengaluru is the right option for this MCQ. Now what is the maximum number of shares the company can buy back as per resource test? As per resource test, what is the limit, sir? 25% of, open the bracket, paid up capital plus free reserve plus securities premium. Correct? So how much is paid up capital? 17 lakh. How much is general reserve and P&L free reserve? Yes. And should security premium also be considered for this purpose? Yes. I mean, add all these 4. How much you going to get? 7. That's what I've done over here. 17 plus 23.5 plus 2 lakh plus 2.5 lakh if you do, you will get, how much is that? 17 plus 23.5 plus 2 plus 2.5 if you do. My calculator is showing 45 lakhs. This only we call it as equity. Equity for this. So 25% of that equity number. So this if you add, you'll get 45 lakh. 45 lakh ka 25% is how much? 11 lakh 25,000. Correct, people? This is what? All these are number of shares or value? I mean, this 11 lakh 25,000 is also value of the shares that you can buy back. And what is the what is the buyback price per share? Value of one share is how much? 30. Total value of buyback is 11 lakh 25,000 and value of one share is 30. So how many shares can you buy back? 11 lakh 25,000 divided by 30 if you do, you'll get 37,500. That is the maximum number of shares which the company can buy back as per resource test. Any problem in this? No. Last test is debt equity test. What does this debt equity test say, sir? The debt equity ratio post buyback, meaning after buyback, should not exceed 2. Maximum debt you can have is, for 1 rupee equity, maximum debt you can have is 2. It should not exceed that. But this debt equity ratio should be calculated after buyback. One method is, I told you, the X method, right? But you will use that X method when they ask you to solve buyback questions fully. Now this is an MCQ question. So will they test how you answered it, or only that final answer is what we require? Final answer. That means you remember I had also given you one shortcut method. We will use shortcut method over here because anyway workings will not be checked. Okay, first, how much is the total debt? We just now wrote here. Total debt is how much? 46 lakh 50,000. That means what is the required equity? Debt equity ratio after buyback should not exceed 2. Meaning debt can be 2 times of equity, or equity can be half of debt. Yes, no sir, equity should be half of debt. So what is the required equity? 46 lakh 50,000 divided by 2, which is how much? 23.25. This is what we need. This is what we require. How much we have? We already added this. Equity means this only. If you're adding all this, how much are you going to get? 45 lakh. Existing equity is 45 lakh. How did I get 45 lakh? Paid up share capital plus free reserve plus securities premium. That same number we have added over here, and we got it, getting it as 45 lakh. We need a 23.25. We have how much? 45. That means, do we have excess? Yes. If you have excess, that only we call it as surplus. In surplus scenario, can you do buyback? Yes. How much is surplus? How much extra equity we have? These two come minus 0. How much extra is that? 21.75. So how many shares can you buy back? In fact, I had given you the formula there. The formula was surplus divided by buyback price plus face value. Why face value? Is because we also need to create CRR. That's the reason I told you. So surplus is 21.75 divided by buyback price is 30 plus face value of each share is 10. Do that, you're going to get 54,375. So this is the maximum number of shares you can buy back as per the debt equity test. If you don't want to use this approach, you can also use that X approach. Answer any which way will be same. Okay. I suggest for MCQ use this. Alright. For a bigger, normal, regular question, use the X method. Then are people? In fact, this whole question was anyway a repeat. Nothing new over here. I hope I can move forward to the next. Alright. As per AS 19, lease is applicable on which of the following leases is what they're saying. Okay. For lease agreements to explore natural gas. For natural gas and all, we have a separate standard called exploration standard. Lease will not be applicable. First of all, what is lease ka definition? Lease is a contract between two parties, lessor and lessee, wherein lessor will give right to use the asset to the other party called lessee for a certain duration called lease term. In return, lessee has to make some periodic payment called lease payment. Yes, no? Correct? This is what is the definition of lease. So check. Legal owner of the asset conveys to another party in return for a payment or a series of periodic payments the right to use an asset for an agreed period of time. This is what indirectly is what? Lease ka definition. I mean, this itself is what, sir? Answer. They just based an MCQ question based on definition of lease. That's it. Once you identify other answers, a right answer, don't worry too much about other options. Because for the sake of it, they will construct a lot of options. If you have got the right answer, move on to the next. That's fine. How should dividend paid be shown by the company in cash flow statement? So dividend paid is what activity? Whether it's equity dividend or preference dividend. Equity shares, preference shares are all a way of source of finance. That means a dividend paid, equity or preference dividend paid is what activity? Financing activity. And the financing activity, you will show it as minus. Correct? Now they did not ask plus minus. They asked where will you show? It will come under financing activity. Any problem? No? Okay. Next question is on accounting standard 2. 31st March 2024, Sri Radhe Shyam Enterprise finds that the cost of partly finished goods is 530. It's a repetitive question. The same question is there in our study material also, maybe with a different number, but any which way, we'll still cover it. Sir, partly finished product means, is it raw material, finished goods or WIP? WIP. And we know, how should the inventory be valued at? Doesn't matter whether it is raw material or work in progress or finished goods, inventory should be valued at cost or NRV, whichever is lower. Right? Raw material ka inventory valuation is linked with finished goods. Yes. So we're not talking about raw material, we're talking about WIP. How should the WIP should be inventory valued at? Cost or NRV, whichever is lower. And how do you get NRV? Estimated selling price minus estimated selling expense minus further completion cost, if any. That's what we have studied. Yes. So this particular company have already incurred the cost of partly finished product is how much? 530. So this is a WIP. WIP ka cost is how much? 530. One more component we need is NRV. This unit can be finished in next year, that is 24-25, by an additional expenditure of 330. So this is further completion cost. It will be considered for what calculation? NRV wala calculation. The finished goods can be sold for 750. So this is your, if you have to calculate NRV. So what is the equation? Selling price. What is selling price? 750 minus selling cost. Is there any selling cost? Yes. To sell the product, you have to pay 8% brokerage on the selling price. So selling price is 750. 8% brokerage is how much? 750 ka 8%, which is 60. So that is your selling expense minus further completion cost, if any. So should you have to incur any further completion cost? Yes. To complete this product next year, how much it is expected to be incurred? 310. So this is your further completion cost. Reduce it. This is your selling price. This is your selling expense. This is your further completion cost. If you reduce, you will get NRV to be 380. How should WIP ka inventory be valued at? Cost or NRV? 530 or 380, whichever is lower. Which is lower? 380. So that means you will value your finished goods at net realizable value itself. So which option has 380? B for Bengaluru. Select that. That's it. Ditto question. We have done all these questions in our regular class as well. Done, people? So this was your MCQ. If you just check, entire 30 marks ka MCQ was pretty much straightforward. Not even one was any complex as such. Yes. Okay. Now let's see. Now the descriptive part constitutes about 70 marks. We know the breakup of the paper, right? In 100 marks, 30 will be MCQs, the rest 70 will be from descriptive, and one will be a choice. Totally 5 questions they're going to give, and you need to answer among them 4. And usually question number 1, normally is question number 1 is a compulsory question, meaning you have to answer them. So now I'll see what are the new questions I handed up. Only that particular questions will be covering. So this is a repetitive question. I've given the question number reference also. There's a class note card question number. 1B repetitive. Okay. This is 2A repetitive. Ditto question is there, or concept is same. This 2B is also a repetitive question. 3 is also repetitive. 3B is a new question. 4 is a repetitive one. Okay. Then 5 is a new question. So totally we'll have to do 2 new questions, you could say, has come from this MTP. Rest everything is around the same concept, or mostly study material question copy paste they've done in this particular MTP. Okay. So alright. So we will take up question 3B. Okay. This is also more or less repetitive. 90% of this question is also same. But one adjustment, drastically they've changed our approach, which I want you to, which I'll be taking you through this question. Okay, so we'll see what we can learn from this question. Following information of Rocky Limited as on 31st March 2024. In fact, just read off the requirements so that you'll get the questions better. Following scheme of internal reconstruction. So this is a pure question on internal reconstruction. So now you got what the question is all about. So let's read the data once to be sure. All the numbers are in lakhs. Fully paid up equity shares of 10 each, 500 lakhs. We have capital reserve. Capital reserve. Sir, usually in internal reconstruction, it will be a loss-making companies. Loss-making companies will have a reserve? No. If at all you have a reserve, can you utilize it for internal reconstruction purpose? Yes. That means if required, from capital reserve, you can transfer this to what, sir? Reconstruction account, or also known as what? Capital reduction account. Yes, no, if need be, if there is any shortage, we can transfer from capital reserve to reconstruction account or capital reduction account. We'll see. That's the reason I'm just put a small highlighter there to create that awareness. 12% debentures is 200. Debenture interest outstanding they've given. Trade payable, directors, this is okay, pretty much same. Goodwill is being given over here. There's some new approach they've utilized towards goodwill. That's what we'll be learning from this question. These are all your normal assets, that's okay. Here, discount on issue of debentures. If you flip open my notes, in fact, I told internal reconstruction, miscellaneous expenditure, preliminary expenditure, deferred revenue expenditure, if they've given to you in the question, you need to write it off. This is an outdated concept. In majority of the cases, it was not seen. The last 4 or 5 attempts, I have not seen this adjustment at all. But now suddenly they have introduced. So discount on issue of debentures is what? It's like your deferred revenue expenditure. That means, can we keep this or we should write it off? We should write it off, because eventually discount on issue of debentures, where will it go to? P&L. And what are we doing for P&L in internal reconstruction? Are we keeping it or writing off? writing off. So even discount on issue of debentures also should be written off. Whether question mentions this or does not mention, you need to compulsorily do this. Do not forget. That's the reason I've just put a small mark against that. Okay, and also P&L account they've given. P&L we already know, yes, no, and P&L is given below assets, sir. P&L is given below assets. That means P&L account has a credit balance or debit balance? Debit balance. That means this is what? Profit or loss? Loss. In internal reconstruction, P&L debit balance, will we keep it? No, we will write it off, provided your reconstruction account has enough balance. Alright, so those are some pointers. Now let's read off these adjustments one by one. Following scheme of internal reconstruction were framed and approved by the tribunal and all the concerned parties, blah blah. First, all equity shares are to be converted into same number of fully paid equity shares of 2.5. Sir, currently how much is my face value of each share? 10. From 10 it is becoming how much, sir? 2.5. That means how much is a sacrifice made by one shareholder? 7.5. What is the journal entry? We know this. Old share capital should be cancelled. Instead of that, new share should come in. Share capital has what balance? Credit balance. How do you cancel it? Debit it. So what's the journal entry for this? Equity share capital account debit. How much was old equity share capital? 500 lakh. What is the face value? 10. That means how many shares we had? 50 lakh shares of 10 each it was. Correct? No, that's what I've written in bracket. 50 lakh shares of 10 each. How much? 500. To what? To equity share capital. Did the number change or same? Same. But the value from 10 it has become how much? 2.5. 15 to 2.5 will become 125. Balance is a sacrifice made by the equity shareholders, gets transferred to, either you can transfer it to reconstruction account or capital reduction account, your choice. Don't use both, use one, either reconstruction or capital reduction. And don't forget the narration. The narration में keywords. Being approved scheme of reconstruction dated ... You remember all that? Yes, so narration is a must. Unless the question says narration is not required, narration you have to compulsory write. But in the interest of time, I have just written the entries, I have not written the narration. Alright, first adjustment is done. Directors agreed to forego their outstanding remuneration. So, do you have any outstanding remuneration, directors? Yes. How much is that? 10. Should we have to pay this or sacrifice? So, this director's remuneration outstanding means it's a liability, correct? No? Correct, that's the reason it's coming on the equity liability side. This liability we have to settle or sacrifice. That means that liability we need to cancel. Liability has what balance? Credit balance. How do you cancel it? Debit. So the journal entry will be director's remuneration outstanding account debit to reconstruction account or capital reduction account 10 lakhs, 10 lakhs. Yes. Okay, next is what? Debenture holders agreed to forego. Forego means sacrifice. Outstanding interest. Okay, stop there. Do we have any outstanding debenture interest? Yes. How much is that? 48. Is company settling this or sacrificed? What's the journal entry? Even there is also a liability. It's an outstanding expense which is a liability. Liability has what balance? Credit balance. How do you cancel it? Debit. So the journal entry will be debit. Use the same name. Debenture interest, outstanding account debit to capital reduction account 48 lakhs. 48 lakhs. Done? Okay, in the same sentence, they also continued and they said, the debenture holders agreed to forego outstanding interest in return of their 12% debentures being converted into 13% debentures. If you just check the question, currently it is 12% debentures, but debenture holders, they want 12% or they want to barter? They want to barter. This 12% they want to make it to 13%. Different value or same value? Same value. So debenture is a liability. Old liability you need to cancel and create a new liability for different value, same value. But old liability was 12%, new liability will be for 13%. So the entry will be what? 12% debentures account debit to 13% debentures account, 400 lakhs, 400 lakh. All the numbers are in lakhs, so I'll just write it in numbers there. Easy so far?
Yes,
sir. Excuse me. Okay, this is done. Next, existing shareholders agreed to subscribe for cash, fully paid up equity shares of rupees 2.5 each for 125 lakhs. Obviously, just in internal reconstruction, you not only ask the shareholders or people to sacrifice, but also you need some money. So we are raising money how here? By giving new equity shares. And how much money totally we raised? 125. And each share we issued at what price? 2.5. So is there any premium here? No. Because it is issued at 2.5 itself and the total worth is how much? 125 lakh. What's the journal entry for shares issued, sir? You can write bank to equity share application. Second entry, equity share application to equity share capital. Or you can pass one entry. What is that one entry? Bank account debit to equity share capital 125 lakh, 125 lakhs. I think study material passes the entry like this: bank account debit to equity share application. Then they will write equity share application to equity share capital. In my view, this is also fine. Or if you want to sync up with study material, you can pass it like that. Your choice. Done, people?
Yes, sir.
Okay, so this is done. Okay, we'll tick off. Next, anything else there? Yeah. Trade payable are given an option to either accept fully paid up equity shares of 2.5 for the amount due to them. Okay. One option is given to the creditor saying it's actually trade payable. Trade payable means creditors and bills payable. But when we have read the question, we don't see any bills payable in the question. Directly they give you trade payable only over there. So that's okay. So one option is given to the creditors or trade payable saying either you can accept equity shares for 2.5 each. That is one for the amount due to them. Or another option is or to accept 80% of the amount due in cash. So two options are given to creditors. Either take equity shares where I will give you full value, or if creditor says I want cash, then we will give full value or only 80%. 80%. That means 20% is going down. Creditors have to sacrifice. So now what did they? There's an option given. So we don't know what they chose. So let's read further. Trade payable of 65 lakh rupees accepted equity shares. So if they go for equity option, should they have to surrender anything or full amount they will receive? Full amount. So here they will receive full amount. Okay. Whereas those for 100 lakhs. So 1 second. 65 lakh and 100 lakh. You sum it up. How much is it? 165 lakh. Go back to the balance sheet. How much is trade payable value? 165 lakh. That means in this 165 lakh rupees, 65 lakh of them have gone for equity share option. 100 of them have gone for cash option. In equity shares option, you get 100% of the money, meaning you will get entire 65 lakh. But in cash option, you don't get 100%, you get only 80%. That means you will get only how much? 80. That means totally how much are we paying to creditor? 145. Instead of 165, we are paying them 145. That means 20 is going down. Fine now. So we need to pass an entry for this. Is trade payable fully cancelled? Yes. We have settled either some through cash, some through equity shares. What's the journal entry for trade payable settled? Trade payable account debit 165 to equity share capital 65 to bank. How much did we pay for bank? 80 lakhs. So to bank 80, balance is the sacrifice made by them which goes off to capital reduction account 20 lakhs. This is a trade payable adjustment. Easy. Okay, moving along. Assets were revalued. Some asset would be increased, most assets would be reduced. For that, we need to pass a journal entry. Assets are revalued. Land building was at 230. Go back to the balance sheet. What was the land original value? 184. From 184, it became, maybe I'll write it parallelly over here. Building machinery, how much is it? 286. Inventory and receivables. Inventory is how much? 142. And this is 80. Okay, now. That means you tell me, sir. This is the book value, this is the revalued amount. From 184, it became 230. So that means this is a revaluation increase. How much is revaluation increase? 46. This is from 286, it became 220. That means 66 is a reduction. From 142, it became 120. That means the reduction is 22 is the reduction. From 80, it became 76. So the reduction is 4. So 3 assets ka value have decreased. 1 asset ka value has increased. So these 3 I will pass a compound entry. This one will pass it separately. Land value you have to increase. Land is an asset. Assets have debit balance. To increase what we have to do? Debit. What's the journal entry? Land and building account debit to capital reduction. How much was the increase? 46 lakh rupees. Done?
Yes, sir.
Then 3 assets have reduced. So what's the journal entry to reduce assets? Assets have debit balance. To reduce we have to credit. So what's the journal entry? Capital reduction account debit to 3 assets. So those plant and machinery 66, inventory 22 and receivable is 4. These 3 are passed, correct? But there could be more also, so we'll write off that also, right? So now this is where the question stops. Now first is we have discount on issue of debentures 8. Can we keep it idle or write it off? This is like a preliminary expense, not preliminary expense, this is more like your deferred revenue expenditures, okay? Which now anyway they don't do it, but any which way, but still an outdated question. Maybe they've copy pasted from 4 or 5 attempts ka, or maybe 6-7 years ka, gone back and copy pasted this question. Maybe that's the reason it's appearing. But anyway, still, can we show this or write it off? It's coming under which side? That means it has what balance? Debit balance. How do you write off something which has debit balance? Credited. So what's the journal entry? Capital reduction account debit to discount on issue of debentures. How much? 8. That's what I've written over here. Done, people? Okay. Now one major change which they have done is goodwill. Normally, sir, the thing is what approach we used to say in our classes, unless they give anything, do not write off intangible assets, because that was they had followed in ICA materials. Okay, unless they mention anything about intangible assets, do not write it off. Okay, because that's the approach recently they have started. But few years ago, but 5-6 years ago, ICA approach was intangible assets you write off. All intangible assets you write off. That was the approach they're following. But now what is the approach they're following? Write it off only if the question mentions. But in this question, again, they took U-turn. Goodwill, they're saying write it off. Goodwill, they are saying write it off. Whether mentioned in the question or not, goodwill you write it off, like that they're given a note. So we'll follow the same approach for our next 2-3 attempts. Let's see where the changes will agree. Okay. But again, all this no unit. Goodwill I can still understand, because is goodwill a purchased asset or a bookish asset? Goodwill only will come due to accounting standard 14. Yes, sir. When you purchase some other company ka business, if you pay extra, that difference only we call it as a goodwill. So it's not really an asset purchased. So in my view, goodwill should be written off. But other intangible assets like patent to software and all, you purchase. That means, can you really see, if you're writing off, means you're treating them as worthful or worthless? You're treating them as worthless. Can we blindly conclude one patent, one copyright on one software is worthless, or question should mention? Question should mention. So we will follow that approach in the examination going forward. What is that approach? Other intangible assets you write off only if question says. Goodwill is a what? Is it really a purchased asset or a balancing figure? Balancing figure. So goodwill, you will write it off whether the question mentions or it does not mention. Is this okay with you? Now, in this problem, do we have goodwill? Yes. Did the question ask us to write off goodwill? No. But will we still write it off? Yes. Understood the difference between what we have done in regular class versus this MTP ka viewpoint? Yes. What is the journal entry to write off goodwill? Goodwill has debit balance. How do you write off? Credit it. So the entry will be capital reduction account debit to goodwill. How much? 15 lakhs. That's what is written over here. Done, people. Next is the online. Also, everyone is okay with this new point, right? Can you just give me a quick confirmation on the goodwill, everybody? Those of you who have joined in from the beginning, not just joined now. Comfortable now? Yes. So the goodwill point, you write it off whether question mentions or it does not mention. Other intangible assets, do it only if the question says. So that's my viewpoint. Suddenly, if I say it takes one more U-turn, don't blame me. Okay, because this is my viewpoint. I'm saying. Okay, this we wrote off. This we wrote off. How about P&L debit balance? Should we write it off? Yeah, whether question mentions it or not, still we need to write it off. How much is that? 390. So this also we need to write it off. Done, people. So if you do this, you'll get 505. But unfortunately over here, not unfortunately, your capital reduction account does not have enough balance. See, P&L you'll write off only if capital reduction account has enough balance. If you don't have enough balance, what do? Write off only to the extent of balance available. But here, exact shortage, irony here is you have exact shortage of 6. You need how much to write off P&L? 390. But if you do the math, capital reduction balance will be 384. There is a shortage of how much? 6. What is that 6, sir? Capital reserve. 6. I mean, we wrote it previously only. If required, you can transfer from capital reserve to capital reduction account. Since we have a shortage, we'll pass one more entry. Okay. So what is that? Capital reserve account debit to capital reduction account 6. This way, entire components you can write it off. You will not have any shortage, nor will you have any surplus. Capital reduction account will perfectly get tied out. If you want, you can put up a capital reduction ledger and see there will not be any balancing figure. It has tied out. That was a problem. So one good thing is, in fact, 3 new things. One is on goodwill. Another one is discount on issue of debentures. Another one is if you have any extra reserves like general reserve or capital reserve, can you use it? Yes. That's the 3 takeaways of this particular MTP question. This is a note which ICA has given in the problem. Goodwill, losses, etc. should be written off whether question mentions in the problem or not. That's the exact note they have given, which I have copied it for your reference. So now you need a minute to review, or can I go for the next question, sir? Next question is okay? Online also okay? Alright. Question number 4 is a ditto question. Okay, we have this. Okay, similar question. It's a preparation of financial statement wala question. Okay, all this we have. Maybe this adjustment was, rest everything was copy paste from previous type of question only. Sir, will this be uploaded in YouTube? Yes, this will be uploaded in YouTube also. May not be everything, okay, but it will be uploaded under your course also. Alright, in the paid version and a live online version, we will upload it. YouTube may one or two we will upload it, not everything. Okay, we'll decide what one to upload. Okay, everything should not give it for free, no. Our family also should run, no. Yeah, okay, we'll decide on that. For now, don't worry about that. Concentrate on this. Yes, transfer. This is a preparation of financial statement wala question. Transfer 20,000 to general reserve as proposed by board of directors. That means what will happen? I mean, what is this adjustment about? 20,000 you have to transfer from P&L to general reserve. Because of this adjustment, P&L balance will reduce by 20,000. General reserve balance will increase by 20,000. This adjustment where will you do? In note number 2, reserves and surplus. Normally in preparation of financial statement, note number 1 is for share capital. Note number 2 you prepare for reserves and surplus. There you have to do it. Okay, one simple adjustment. P&L you have to reduce by 20. General reserve you have to increase by 20. Okay, rest every question is ditto from our class notes or ICA material only, no change. Can I move forward, sir? Everybody?
Yes, sir.
Yes. One more new questions if you are done means this particular MTP ka we have covered. Okay, so this is your question number 5. So let's see this. Excuse me. A Limited and B Limited are carrying on the business of the same nature. On 31st March 2024, information given by both these companies are as follows. So, two companies ka data they have given. Probably this is an amalgamation or consolidation question, maybe we'll see. Okay, if you want, we can confirm it. A Limited took over B Limited. That means this becomes your amalgamation AS14 wala question. Okay, fine. So, they've given the data. So, equity share capital is of 10 each. 10% preference shares of 10 each, 10% preference shares of 100 each, 8% preference shares of 100 each. One company has 8% preference shares, another company has 10 and 8%, different rate of preference shares both the companies have. General reserve they have given investment allowance reserve, security premium, export profit reserve and P&L. All these are your reserves in surplus. Then they have given 9% debentures of 10 each, that's okay. Secured loan, creditor, bills payable, other current liability, all these are liability. So I have drawn a line. Then starts your assets. From land and building to cash and bank, they have given various assets. Fine, usual balance sheet, nothing much fancy. A Limited has taken over B Limited. So A is the purchasing company, B Limited is the selling company. On the above date, both the companies have agreed the scheme of amalgamation in the following terms. A Limited will issue rupees only 80,000. That means this 80,000 is the number of shares. And what shares is that? Equity shares of how much value? 10 each, and it is issued at par itself. To whom? Equity shareholders of B Limited. Sir, what the purchasing company pays to the owners of selling companies only what we call it as PC, purchase consideration. So is this PC? Yes. How many shares? 80,000 shares of face value 10 and issued at 10 only. That means this will be how much, sir? 8 lakh rupees. 8 lakh rupees is it part of PC? Yes. Okay, but we have only one owners here. No, selling company has equity shareholders and preference shareholders. So for equity shareholders, 8 lakh is given so that we are comfortable. Fine, we'll read off the whole question. A Limited will issue 10% preference shares. Stop. Selling company is B Limited. B Limited has what percentage preference shares? 8%. But is A Limited giving 8% preference shares or 10% preference shares? 10%. A Limited will issue 10% preference shares of 100 each to discharge or to settle preference shareholders of B Limited at 15% premium. Okay, now stop there. How much is the value of preference share capital of B Limited? 5 lakhs. But is the selling company taking this over at 5 lakh or 15% extra? So calculate 5 lakh ka 15% is how much? 5 lakh 75,000. Correct?
Yes.
Any problem?
No.
Okay, the value of old preference shares is assessed to be 8 lakh or 5 lakh ka 75,000. But read this line, this is important, this is the highlight of this question in fact. A Limited will issue 10% preference shares of 100 each to discharge preference shareholders of selling limited, that is B Limited, at 15% premium in such a way that existing dividend quantum means value. Quantum means value. Existing dividend quantum of the preference shareholders of B will not get affected. Okay. In fact, we had done one question on this. 8% return on capital employed, something was there in our PC calculation wala problem. Somewhere using that sentence only they've used and tried to construct. That's okay, no problem. We will decode this into smaller parts. Okay, again I'll put it up, but just let's understand this. They said quantum of dividend should be affected or not affected. That means indirectly what they're trying to say. Whatever dividend they used to get in the earlier company, same dividend they should get now. They should get now also. Correct? Yes, people?
Yes, sir.
Okay, now go back. B Limited is a selling company. What percentage preference shareholders? 8%. What is preference share capital? 5 lakh. What is preference dividend? 5 lakh ka 8%, which is 40,000. Any problem? Any problem or okay? That means currently the selling company ka preference shareholders are getting preference dividend worth 40,000. After the business has been purchased, should preference shareholders get more than 40,000? No. Less than 40,000? No. Exactly how much? 40,000. Me telling problem. Because they said over here quantum of dividend should not get affected. Yes sir. But this is crazy, no? The dividend should be how much? Dividend should be how much? 40,000. But preference shares ka value is how much? 5,75,000. So preference shares ka value is 5,75,000 because they told in the problem we are not taking preference shares at par, you are taking at 15% premium. So if you calculate, you will get 5,75,000. And what percentage preference shares are given? 10%. So if you do this, 5,75,000 is a value. Dividend rate which new preference shares carries is 10%. So if you do it, you are getting 57,500. But they told in the problem, no, it should not exceed 40. That means what? Sir, dividend is always calculated on the face value. This 5,75,000 no is not face value. It is the premium. There is some premium element included over here. Understanding? That is the hidden adjustment. Everybody understood? Okay, it's like you're giving something extra, but at the same time not giving extra. Because you told the preference shareholders instead of 5 lakh, I will give you 5 lakh 75,000. They're full doing balle. But the moment they started, you said, wait. Earlier, how much dividend you are getting? 40. Now also you will get 40. That means full toss only. So indirectly, these preference shares are issued at premium. Okay. They'll ask you to prepare balance sheet and all. So that's the reason. Or they'll ask you to prepare journal entry and split up would be a necessary. Comfortable? Yes. Did you understand the crux of the adjustment? Solving presentation part I'll show you. But understanding wise okay?
Yes, sir.
Alright. Online also okay now people? Yeah, good morning. Now somebody logged in. Yes. So far good? Alright. Tell me sir, in simple terms, forget about all this. How do you calculate dividend? How do you calculate? In terms of equation, express that. How do you get preference dividend? If you want preference dividend ka amount, how will you calculate? Will you take preference share capital or face value? You will take face value of preference share capital and multiplied by the dividend rate. Correct now people?
Yes.
Now they gave clearly in the question that after you issue new preference shares, should existing preference dividend change or same? How much was existing preference dividend? 40,000. That means after this amalgamation also, dividend which preference shareholders are going to get is 40,000 only. But new company gave 8% preference shares or 10% preference shares? 10% preference shares means the dividend rate will be 10%. Any problem here? That means what is the face value of preference share capital?
4 lakhs.
Therefore, face value of preference share capital will be 40,000. 10% is 0.1, which will be how much?
4 lakh
rupees. So, but you are giving how much? 5,75,000. But the face value is only 4 lakh. That means indirectly what it is? 1,75,000 is your security premium element. These preference shares are issued at premium. That's all we need to keep in mind if they ask the journal entry. Otherwise, not required. Everyone understood?
Yes.
Any problem? No. Can I move forward? Okay, so we got the PC. What is the PC value, sir? For equity shareholders, how much you gave? 8 lakh. For preference shareholders, totally how much you gave? 5,75,000. That means if you add the two, you will get PC, no? PC means what you give it to the owners of selling company. We have two approaches for PC. If PC is missing, then we calculate net assets and net assets only becomes PC. Here PC is missing or clearly given? Clearly given. How much value of equity shares was given? How much value of preference shares given was clearly mentioned. So PC is what? Net asset method or net payment method in a way? Net payment, meaning PC is clearly given. Okay, I think this, if you have sorted this means over, the question is over. This was only new adjustment in this particular question as far as I'm concerned. Alright, debentures of B Limited will be converted into equivalent number of debentures of A Limited, obviously. The old debentures you need to cancel and issue new debentures for relating to new company. Even if they don't tell that, we usually do this in all our problems. All bill receivable of A Limited were accepted by B Limited. What is bill receivable of A Limited? This is your A Limited. A Limited ka bill receivable value is how much? 60,000. That means this only we call it as what, sir? Mutual owings. Correct? Alright. So this is your mutual owings. What you should do for mutual owings? In amalgamated balance sheet or new company ka balance sheet, you need to reduce mutual owings both from asset as well as liability. Which asset and which liability? Bill receivable and bills payable. This is a balance sheet adjustment. If required, journal entry also we need to pass if they ask. A contingent liability of B Limited of how much? 72,000. 1 second. Contingent liability means will B Limited record this or disclose? We have studied as per AS 29, contingent liabilities are not recorded. They are only disclosed. Relates to how much is contingent liability value? 72,000. Is to be treated as actual liability in trade payable. Now, is it really a contingent liability or it became actual? Actual. So, actual liability in a way belongs to which company? B Limited. And who's taking over this? A Limited. That means along with the normal assets and liability, one extra liability has to be taken over worth how much? 72,000. Okay now people? Yes, the journal entry we will see for this, but first let's figure out what method of amalgamation is it. Sometimes they give you the method of amalgamation, right? If they give the method, we will choose that. In fact, we can read off this also. Pass opening journal entries in the books of A Limited. So purchasing company ka books mein they are asking journal entry and they are also asking you to prepare balance sheet and assume amalgamation in the nature of what? Merger. They only told, if they tell means should we have to test those conditions? Not required. Only if they don't, then we have to test the conditions, right? Here it's given as merger method. So under merger method, one liability you have to take over. What is the journal entry for liability? You have to, A Limited has to take over one liability and record. So what do we use? P&L account debit to contingent liability account. In fact, they are asking you to treat this as contingent liability or it's part of trade payable. That means instead of trade contingent liability, you can pass it as TP. TP as in trade payable. Okay, so this is a journal entry for how much value? 72,000. Then there is also amalgamation expense. We know this. What are, under merger method, what is the journal entry for amalgamation expense? P&L account debit to bank. How much? 12,000 rupees. Done. These are all regular adjustment. This contingent liability also is one of the new adjustment. Okay. So requirement we know. Can we pass off the journal entry? Yes. But before you pass the journal entry, first we need to calculate PC. PC missing or given? Given. So again we will calculate how much equity shares was given, sir. 80,000 equity shares of 10 each. So how much was given for equity shareholders? 8 lakh. This is one part of PC. New equity shares are issued by the company or purchasing company to the extent of 8 lakh. There was new preference shares given? Yes. How much value? 10%. That they told what? Preference shareholders of selling company will be taken over at 15% premium. What is the preference share capital of the selling company? 5 lakh. Is it taken over at 5 lakh or 15% extra? How much is that? 5 lakh 75,000. That means the value of preference shares, new preference shares given is 5 lakh 75,000. Any problem? These two if you add, you will get total PC which is 13 lakh 75,000. Since they ask us to prepare journal entry and balance sheet, are these new preference shares issued at par or premium? Premium. So how to calculate? I've just brought out over here. It's the same way I explained over here. Existing preference dividend is how much? 40,000. New preference dividend is how much? 10%. That means what is face value of preference share capital? 40,000 divided by 10 which is 4 lakh. That's what I've calculated over here. Face value of new preference shares is what? Directly I've written 40,000 divided by 10% which is 4 lakh. So in this 5 lakh 75,000, 4 lakh is the face value of preference shares. Balance constitutes your securities premium portion. So when you're passing journal entry and in balance sheet, this has to be captured. Even if you don't show it here, not a big deal, but in journal entry compulsorily, you need to show it out. Need a minute or can I move forward?
Move forward.
Online also okay, G? I'm just freezing the screen in case you have to update anything there. Okay, just go through. Online, can I carry on? Okay, now next they ask the journal entry. Tell me, sir, in amalgamation, normal few journal entries will come. In fact, 3 journal entries is pretty much basic. What is that first? Business purchase account debit to liquidator of selling company. Which is the selling company here? B Limited. How much did you buy the business for? PC is how much? 13 lakh 75,000. Its merger method means very straightforward. All assets, all liability will come at book value. That's all. No. Under purchase method, purchasing company takes over only assets and liabilities of the selling company. But under merger method, assets, liability and even reserves and surplus of the selling company are taken over. Comfortable, or do not forget that. But we don't have to worry because all these assets will be taken over at book value. So straight away copy the assets from here. Land and building 840, 560, 210. 840, 560, 210. Then 3 lakh, 420, 320. 3, 420, 320. Then next 70,000 and 61,000. Updated all assets what they have given in the question we have taken over. All assets debit one by one. To what? All liabilities debit one by one as well as reserves and surplus debited one by one. And balancing figure is nothing but your general reserve. Because in merger method, what do? PC we compare with paid up capital and accordingly the difference we will adjust it in general reserve if it's a loss scenario, correct? Even if you don't do that, in journal entry number 2 only you will get general reserve as a balancing figure. So instead of putting a separate working note for that, I'm getting directly general reserve as a balancing figure. Is that okay? If you put that as a working note, not a big deal, that is also acceptable. Fine now? Alright. Liabilities, all the liabilities one by one. So 75, 1 lakh and 204. I will not take 204 over here. Why not? We also took over one trade payable extra. How much? 72,000. That means the trade payable is 72 or 204 plus 72. 204 plus 72, which becomes 2,76,000. If you want for this 72,000, you can pass a separate entry. P&L account debit to trade payable. Or you can club it here only. I suggest club it here only. Or if you want to show it separate entry, you can do it. Done now?
Yes, sir.
If I club, I hope everyone understood this.
Yes,
because it is not 204. Selling company has one more amount of trade payable to the extent of 72,000. Selling company had recognized this as a contingent liability. Now they are saying that it is not contingent liability, it is an actual liability. And that liability forms part of which account? Trade payable. Hence, I am adding 72,000 to trade payable. Okay, fine. Fair enough. Somewhere here you can add bills payable, you can add, it's alright. Okay, people. So now this will be what? 75 plus 1 and 276. Show now. 75 lakh, 1 lakh and 276. I put a highlighter against this because to show that I have added 72,000 over here. As I said, if you don't want to add it here, you can also pass a separate entry. What separate entry you will pass? Third entry where you will pass P&L account debit to trade payables. How much? 72,000. If you want, you can pass a separate entry if you don't want to show it here. Final effect will be same. Don't do both. Either directly add and show or pass a separate entry and show. Choice is absolutely yours. Done? Okay, these three I've ticked. The next is what, sir? Where is the next one? Secured loan 360 and this is 200. 360, 200, 192. 1 second. 360, 200 and 192. I can't take 192. Why? Because, sir, what is the journal entry for the 72? P&L account debit to trade payable. Trade payable you increased by 72. That's all. There's one more effect. P&L will reduce by 72. That's what I've done over here. Okay. Otherwise, you take 192 here and pass separate journal entry for P&L. That is also acceptable. But if you want to show clubbed entry, P&L you can't show 192. You have to show 120. Because of this entry, P&L will get debited. P&L has credit balance. When you debit it, its balance will reduce. So hence I've done the reduction. 72 got added here. Same 72 has to be reduced from P&L also. That's the second effect. Okay. Then all other reserves you copy. General reserve you'll get it as a balancing figure. Export profit P&L we captured. Export profit reserve 120. Investment allowance reserve 60. 120 and 60. Okay. Now this business purchase account is an actual account or dummy? Dummy. How do you cancel it? Credit it. It has you have debited here. To cancel we will credit here. Balancing figure is your general reserve. Done, people?
Yes, sir.
That's all is this particular funda all about. Okay, you can't take general reserve at, in fact, how much is the general reserve balance of subsidiary company? 250. But we can't take over 250 due to some adjustments. We are taking over at 95. That is nothing but comparison between PC and paid up capital and adjustment to be done in general reserve. No need for that working note. I suggest in exam directly get general reserve as a balancing figure. It's fine. Done. So first entry over, second entry over. What is the third entry? Settlement to liquidator. What is the liquidator ka settlement? Liquidator of B Limited account debit. How much we need to pay the liquidator? 13 lakh 75,000. What and all we gave the liquidator? Some equity shares and some preference shares. If a company issues equity shares, can you write equity shares or equity share capital? Equity share capital. How much was equity share capital ka value? 8 lakh rupees. And these equity shares are issued at par only. So 2 equity share capital, 8 lakh. To what? 10% preference share capital. Now be careful. Though you took over preference share capital 575, is entire 575 face value of preference share capital or premium is that? In this 575, 4 lakh constitutes face value of preference share capital and balance constitutes what? Securities premium. So you'll write here to 10% preference share capital 4 lakh, to securities premium 1 lakh 75,000. You can give a reference to working note number 1 or calculate here only, your choice. Done? Then this is your normal entries. Then you'll have to check any extra entries came. Debentures of B Limited will be converted into debentures of A Limited. That what entry you will pass? Here anyway you have credited debentures of B Limited. No. What do? Cancel this. This is a debenture belonging to which company? B Limited. Now we'll have to give debenture certificate of which company? A Limited. Value change or same value? Same value. What is the entry for this? 9% debentures of B Limited account debit to 9% debentures. In A Limited books, we will not write off A Limited. It is understood that if you credit debentures, it means that this debentures belongs to which company? A Limited only. This is the entry.
Yes.
These are all common entries. Yes. So this is done. This is done. All bill receivable of A Limited are having B Limited ka acceptance. This only is nothing but your mutual owings. What should we do for this? Cancel. So how do you cancel bill receivable? Bill receivable is an asset. Assets have debit balance. How do you cancel? Credit. Bills payable is a liability. Liability has credit balance. How do you cancel? Debit. So the entry will be bills payable account debit to bill receivable account. They said all the bill receivable of A Limited is having. What is bill receivable of A Limited? 60,000. So mutual owings amount is how much? 60,000. So you pass this journal entry for 60,000. Okay, G. Alright, next what they said, amalgamation expense. Amalgamation expense, what is the journal entry? P&L account debit to bank account. Instead of P&L, if you want, you can also use general reserve to bank also. But we have stuck to P&L in all our problems, so we'll do that. Okay. Study material, I think in the solution they passed general reserve and they've given a note that instead of general reserve you can use P&L. But we will stick to the same one so that we don't have to change. Done, Asaru? Yes. This is working note and this is your journal entries. That's it. They also asked balance sheet. Balance sheet is pretty straightforward, sir. Nothing, just line by line addition. Okay, anyway, I've done it, so we'll quickly review that as well. Now, take your calculator. If you want, we can confirm. After merger method, what will be the balance sheet is what they've asked. How much is the share capital of equity share capital of A Limited? 12 lakh. Now, can you add 7,20,000? No. You issued new equity shares worth how much? 8 lakh. That means equity share capital will become 20 lakhs. Any problem? No. Next, what was preference share capital of A Limited? 6 lakh. How much new preference shares we issued? Totally is 5,75,000, but that 575 includes premium. What is the face value of new preference shares issued? 4 lakh. So existing was 6, new preference shares issued face value is only 4. So 6 plus 4 is how much? 20 lakh, or rather 10 lakh. So adding these two, you will get total share capital value to be 30 lakhs. Then all the reserves and surplus. Reserves and surplus line by line addition. So first, a general reserve 3 lakh plus, can I take 250 or I have a number? For A, it is 3 lakh. For B, we got it already over here. How much is general reserve of B Limited we took over? 95. So 3 plus 95 becomes 3 lakh 95,000. Then investment allowance reserve. 0 plus 60 is how much? 60,000. Okay. Then securities premium. 2 lakh 40,000 plus 0 plus 1 more came. Preference shares we issued at par or premium?
Premium.
So how much was the premium on preference shares? 1 lakh 75. So add that. 240 of A is B of B cup SP is 0 plus new preference shares issued at premium of 175 becomes 4 lakh 15,000. Then export profit reserve, these two addition 180 plus 120 is how much? 3 lakh rupees. Then P&L. What is the P&L balance? 2 lakh 16. Okay, can I take 192? No, we already have in the journal entry. Check what is the P&L balance of B Limited we took over? 1 lakh 20,000. Because 72,000 we created that contingent liability entry, no? That's it, or one more is there? One more is there because you debited P&L for amalgamation expense. Simple trick is take A Limited ka balance sheet value, B Limited ka balance sheet value you don't take it from the journal entry. That becomes easy. Okay, the P Limited ka or B Limited ka P&L balance is how much? 120. Again, you debited P&L by how much? 12. When you debit P&L balance will reduce. So minus 12 you'll have to do over. That's what I've done over here. 216 of A, 120 of B that came from journal entry. 12,000 is amalgamation expense for which we use P&L. So you'll get this amount. Adding all this, you'll get the total reserves and surplus to be 14,94,000. Done, sir?
Yes, sir.
Rest everything line by line addition. Liability. Secured loan. So secured loan and 9% debentures comes under non-current liability, specifically under long-term borrowings. So add 3 lakh plus 2 lakh is how much? 5 lakh. 5 lakh plus 360 is how much? 8 lakh 60,000. That is your total long-term borrowings. Then is your current liability. Okay, trade creditors, can I take 312? Yes. But here can I take 204? No. 204 plus 72. How much is that? 276. So what about mutual owings? Mutual owings is not from creditors, it is from bills payable. So add these two. 312 plus 276, how much? 312 plus 276 is 5 lakh 88,000. Next is bills payable. For A it is 75, for B it is 1 lakh. That's all, or minus 60? Minus 60. Why is that? Mutual owings. So 75 plus 1 lakh minus 60 you'll get 115. So adding these two, you'll get total trade payable to be 7 lakh 3,000. Correct now?
Yes, sir.
Any other liability? Yeah, we have some other current liability. 50 plus 75. How much is that? 1,25,000. There comes your total equity and liability side. Similarly, add up all the assets. Now it's very straightforward. So PPE, all these three are PPE. Add all this value because anyway book value. Add, sir. Add all this. 1080 plus 840 plus 6 lakh plus 560 plus 345 plus 210. All these numbers you add. How much you're going to get as PPE? Don't add. Okay, 1080 plus 840 plus 600 plus 560 plus 345 plus 210. My calculator is showing 36 lakh 35,000. That's what we have written over here as PP. Okay, now I've showed the breakup of each component also, but I just wanted to total at, see it at total level. Done? Okay, then what do we have, sir? Investments. So investment, again anything? No. 96 plus 3 lakh. How much is it? 3 lakh 96,000. Then current assets. Inventory 630 plus 420. Any stock reserve blah blah adjustment? No. So 630 plus 420 will be how much? 10 lakh 50. Copied. Then trade receivables. Trade receivable means debtors and bill receivable put together. How much is debtors? 490 plus 320 plus bill receivable 60 and 70 minus 60 you have to do. Why is that minus 60? Mutual owing. So 490 plus 320 plus 60 plus 70 minus 60 if you do 8 lakh 80,000. That is your trade receivable ka value. 8 lakh 80,000. Done now. Last one is cash and bank. 172 plus 61. Was there any amalgamation expense? Yes. How much was that? 12,000. So 172 plus 61 minus 12 if you do 2 lakh 21,000. That is your cash balance. Add everything, you'll get the same total. Both the side total matched off. That's all was this question all about. Okay, the takeaway of this question was preference shares are issued at premium. So finding that face value and security premium of preference shares was one crux. Another one was when selling company ka contingent liability was there. It is no more contingent liability. It has become actual liability, which in the form of trade payable. So how to take over that and record it was the highlight of this particular question. Rest everything we have covered. Yes, people, that's all was this MTP ka drama. Alright, nothing new other than this.